In 1973, gas lines snaked around blocks as prices surged. Gas prices have skyrocketed and your purchasing power has diminished. This marks the onset of the 1973 oil crisis, triggered by an embargo imposed by members of the Organization of Arab Petroleum Exporting Countries, OPEC, in response to U.S. support for Israel during the Yom Kippur War. Here's what happened. In October 1973, Arab nations cut off oil exports to Western countries supporting Israel during the Yom Kippur War. This led to a significant reduction in oil supplies and a quadrupling of oil prices over several months rather than overnight. As a result, people began experiencing long lines at gas stations across many Western countries. But why did this matter so much? Because oil is essential for nearly every aspect of our economy, including transportation, manufacturing, and home heating. Suddenly, there wasn't enough supply to meet global demand. The oil crisis of 1973 was a turning point for global markets. Oil is essential to industrial economies and scarcity can have profound effects. While the crisis notably impacted gasoline prices, its repercussions extended broadly, influencing various industries and financial systems worldwide. The oil embargo hit the U.S. particularly hard. In 1973, Americans spent about $8 billion on imported oil. By 1974, that number had risen to over $25 billion, more than a threefold increase. That's like going from buying groceries for a week with one paycheck to needing two paychecks just to fill your tank. So what did this mean for the everyday person? Inflation surged. The prices of essential goods like food rose dramatically, but wages often failed to catch up, leaving people feeling that their purchasing power was declining daily. Let's take a closer look at how this played out in real numbers. The U.S. inflation rate was 3.4% in January 1973. By December 1974, it had climbed to over 10.5%. That's more than tripling the cost of living in just 1 year. But here's a twist. While prices were soaring, wages didn't increase enough to keep up. The average hourly wage in the U.S. fell from $3.70 in 1973 to around $4 in 1974, failing to match inflation rates. This meant that even though you might be working more hours, your paycheck was buying less and less. So how did people react? They started cutting back on discretionary spending. Savings rates increased as people tried to conserve their dollars. However, essential retail sales were hit hard, and some businesses struggled to survive due to reduced consumer spending. Now let's look at what happened in financial markets. The oil crisis of 1973 wasn't just about gas prices, it also dramatically impacted entire industries and global trade patterns. Companies that relied heavily on oil, such as airlines and car manufacturers, experienced significant declines in profits due to soaring costs. Airlines were particularly affected by the rise in fuel costs. In 1973, jet fuel cost approximately 45 cents per gallon. By late 1974, it had increased to over $1.20 a gallon, nearly tripling within 1 year. This significant price increase made flying more expensive and reduced profits for airlines. Car companies faced significant challenges during the oil crisis of 1973. Fuel efficiency became a top priority for consumers, leading to a shift in the market towards smaller, more fuel-efficient cars from European and Japanese manufacturers like Volkswagen and Toyota. American carmakers struggled as demand for their larger vehicles declined. The oil crisis of 1973 highlighted vulnerabilities in global supply chains as countries had become heavily reliant on Middle Eastern oil suppliers, leaving them susceptible to political instability. This event spurred efforts towards diversifying energy sources, including increased investment in nuclear power and coal in some nations. And let's not forget about inflationary expectations. As prices rose, people anticipated further increases, creating a self-perpetuating cycle that made it difficult for central banks like the Federal Reserve to manage inflation without triggering economic downturns. Now here's a key point. The oil crisis didn't just affect markets in 1973 and 1974. It set trends that shaped global economics for decades afterward. For example, energy security became a top priority for many nations. As a result, we saw increased investment in alternative fuels like natural gas and renewables. However, some industries benefited from the crisis as well. Companies focusing on energy efficiency and those producing goods less dependent on oil, such as bicycles and public transportation systems, discovered new market opportunities. So how did global markets recover from the oil crisis of 1973? It took time and significant policy changes. Governments implemented price controls and other measures to try to manage costs. Central banks raised interest rates to combat inflation, which had risen sharply due to the crisis. Companies also adapted their business models to survive in a high-cost environment, leading to restructuring and diversification efforts across various industries. One major development during the oil crisis of 1973 was the increased use of oil futures contracts, which allowed businesses to hedge against future price volatility. This provided more stability for companies dependent on consistent oil supply and pricing. However, one of the most enduring impacts was a shift toward energy independence. Countries began seeking ways to produce their own oil or diversify into alternative energy sources like coal and natural gas. In response, the U.S. increased its domestic production of oil and gas by developing new drilling technologies. Subject: the oil crisis of 1973 and its impact on global markets. Passage to fact check. Fast forward a few years later and you see this shift in action. By the late 1970s, the number of American wells being drilled had decreased significantly from pre-crisis levels due to high oil prices making exploration more costly. This helped reduce reliance on imported oil as domestic production was prioritized, albeit at a higher cost and with greater environmental concerns. Another lesson learned was the importance of diversification. Companies that were able to pivot away from high oil dependence generally performed better over time. For instance, General Motors began focusing on smaller, more fuel-efficient vehicles and alternative technologies like electric cars. This shift proved beneficial as fuel efficiency became a critical selling point for consumers. Now let's look at the stock market during this period. The S&P 500 index dropped over 47% from its peak in January 1973 to its trough in December 1974, a significant downturn. But after the crisis began to ease, markets slowly started recovering. By the early 1980s, stocks had largely recovered and were heading into a long bull market. But here's an important lesson. Just because markets can recover doesn't mean investors are automatically protected from significant losses. During periods like the oil crisis of 1973 to 1974, investors who held on through the tough years saw their portfolios suffer substantial declines. However, those who could endure the volatility ultimately benefited from the market's eventual rebound. Now let's talk about some of the myths that emerged around this time. One common myth is that oil prices will always rise due to scarcity. But history shows us that new technologies and market dynamics can create unexpected changes. For instance, fracking in the 2010s led to a significant increase in U.S. oil production and contributed to lower global oil prices. Another misconception is that government intervention always resolves economic issues. While price controls may provide temporary relief, they can also result in shortages and inefficiencies. Over time, market forces typically offer more sustainable solutions, although this process often involves challenges and setbacks. So why does all this matter today? The lessons from the 1973 oil crisis are still relevant as we face new challenges like climate change and geopolitical tensions in energy markets. Just think about how Russia's invasion of Ukraine has affected oil prices recently. It serves as a reminder that energy security remains crucial for economic stability. Subject: the oil crisis of 1973 and its impact on global markets. In short, the 1973 oil crisis was more than just an event. It reshaped global economics, industries, and financial strategies. It highlighted the importance of resilience in the face of unexpected shocks from political or environmental factors. So next time you fill up at a gas station, remember that prices reflect not only supply and demand, but also geopolitical realities. History, such as the oil crisis of 1973, demonstrates how sudden shifts in global politics can dramatically impact markets. As always, it's important to be prepared for unexpected events, as history shows these are likely to occur again. This is educational and historical, not financial advice. The 1973 oil crisis didn't just hit gas stations hard, it sent ripples through every corner of the global economy. Banks and investors faced volatile markets as oil prices soared, unsure how long these high costs would persist. Companies planning for growth found their supply chains disrupted overnight by skyrocketing fuel expenses. That's what happened in 1973. One concrete example: car manufacturers faced massive production delays as OPEC member countries imposed price controls and export restrictions on oil importing nations. Companies like Ford, GM, and Chrysler all felt the crunch, leading to job losses and plant closures across America's industrial heartland. Meanwhile, airlines either grounded flights or hiked up fares, making travel less affordable for millions of people. The crisis also fueled inflation, eating away at household budgets. Think about it. Groceries and utilities went up in cost as companies passed on higher fuel prices to consumers. The average family felt the pinch every time they bought food or heated their homes. And let's not forget the long lines at gas stations, where people often waited hours just to fill up. The 1973 oil crisis forced nations to rethink energy policies and diversify resources. Many turned to coal, nuclear power, or other domestic energy sources, reducing reliance on imported oil. Governments also started stockpiling oil reserves as insurance against future disruptions. By the early 1980s, countries had begun building up emergency supplies to cushion them during crises. So when you see news about energy sanctions today, remember the lessons of the 1973 oil crisis. Every move in global politics can have significant impacts on markets and daily life. Being prepared means staying informed, planning ahead, and understanding how your own choices might be influenced by broader economic forces. This is educational and historical, not financial advice. The oil crisis of 1973 spurred significant energy conservation efforts globally. Individuals improved home insulation, reduced electricity usage, and opted for more fuel-efficient vehicles. Businesses also responded by investing in efficiency measures to cut costs and lessen reliance on imported oil. In the auto industry, manufacturers began producing smaller, more fuel-efficient vehicles in response to the oil crisis. The rise of Japanese car makers like Toyota and Honda was partly due to their focus on economy and reliability during this period. These changes not only helped manage the immediate effects of the crisis, but also set new standards for future generations of cars. Financial markets reacted dramatically too. Oil prices skyrocketed, causing inflation to soar and dragging down stock markets worldwide. Investors scrambled to find safe havens, leading many to pour money into gold and other precious metals as a hedge against rising costs. This trend continued through the 1970s, fueling both economic uncertainty and new investment opportunities in various asset classes. The crisis in 1973 underscored the geopolitical complexities of global oil supply chains. OPEC nations gained significant leverage over Western economies that were heavily dependent on their crude oil exports. This shift in power dynamics influenced how countries negotiated trade deals, military alliances, and diplomatic relationships subsequently. Today's energy landscape still bears the mark of the 1973 oil crisis. Since then, renewables have grown significantly, driven by both environmental concerns and a desire for greater energy security. Yet fossil fuels remain crucial players in global markets, reminding us that the lessons from history are ever relevant as we navigate current challenges. This is educational and historical, not financial advice.